What's going on, guys? Welcome to Collecting Keys. I'm Mike DeHaan here with Dan Austin and Dylan Cook and special guest Drew Wiard today, who's been on the show, I don't know, 4 times, handful of times.
Yeah, this is round number 4.
I know.
Oh,
I know.
wow.
We should really just make you the 4th seat and we can have like a proper,
Yep.
I don't know, panel, I guess, because you and me are complete opposites.
Yeah. It's
We
a
are.
Hollywood tiles.
It works. It's an odd couple. There's a lot of conflict, but we figure it out somehow.
And like 90% of facets of life, I feel like you and me have different opinions, but we're also still good buddies. We just get along and we're adults about it. So it works out great.
Yeah. Yeah. Well, I mean, I don't know that I'm showing up every single week for you, but maybe once a month we'll come in and
that's fine.
argue with each other.
That's
How about that?
This is what I'm saying. The biggest thing we really disagree on is work ethic. And you just said you're lazy and I'm here every week. So it's fine.
I said I'm committed to other things.
Yeah.
You know, my highest and best use, but I'll sacrifice once a month for you.
Yeah.
That's true. To be fair, if you're looking at, highest and best use per hour, this is probably about as low as it gets.
It's probably for sure, dude.
It's a good distraction midway through my day. It's 1:30 where I'm at. And Drew.
Oh, yeah. You guys are the same time zone.
Yeah.
I will say, though, the biggest value for this podcast, relatively small listenership. We do have a loyal listenership base, is very niche. Going to some of these professional events, as Dan and I are getting larger into the lending space and different things, and being able to tell someone you have a podcast, you always get the same response when you have podcasts. They go, "Oh, that's cool. What's it called?" "Oh, Ralph, I bet that's really fun for you to do that in your broom closet, whatever."
Yeah.
And then they go and they look you up and they're like, "Holy shit, you have 480 episodes." Like that gives you so much immediate credibility because you've shown commitment to something that's hard for a long period of time. And they know that it must be worthwhile for you to do that if you've been doing it for, at this point, 4.5 years.
Long time.
Can we put me on the front eventually? Can I be on the logo?
Oh,
I was actually, so when we ultimately...
I thought you already put him on there.
No, not on the logo.
Oh
when we rebrand from Collecting Keys, since we're not strictly a real estate show anymore, that's exactly what I want to do, Dylan.
Okay, great.
I was talking to somebody recently that's been a listener, and they're like, "Why would you change the name?" I was like, "I know." I was like, "Yeah, it's so hard to come up with a good one." And Collecting Keys could be keys of wisdom.
That's dumb as hell. I veto that immediately.
There's the keys to life right here, children.
Yeah. I like collecting keys better than collecting. Was it you had cash flow?
I was like collecting cash flow.
Yeah,
I was like,
not the same. It's just not the same.
The problem is it's really similar to, like we talked about, just Ryan Dossey's group.
What Dan is wearing right now. He's literally wearing the shirt.
I know. We
Yeah,
can just steal his. We can just steal his brand. It's great. I'll just swear.
We already talked about it.
He posted he's not doing it anymore. So is it really stealing?
He's shooting it for grabs.
He shut down CCF.
He is like just doing his last thing. Yeah.
Oh, dang. This shirt's worth a lot more money now.
It's collector's item.
He's moving from San Diego to St. Louis as well. So apparently, he's had a stroke in his decision making. But
everyone makes mistakes after a while. It's fine.
It's all right. It's family. I do the same thing. I'm stuck in the middle of flyover territory, and so I get it.
Yeah.
I was curious. You were talking about going to professional conferences now, and I don't get to see you at these professional conferences. I see you at KeysCon where, we'll have a drink or two at the end of the night and it's flip-flops and cargo shorts and all that. Mike, do you have a blazer now? Or how do you show up at these professional things?
No. So typically I wear decent jeans and just a button up.
Yeah.
So here's the thing that we've learned is you can tell who the employees are and the business owners are. The employees are all wearing blazers and suits. The business owners are wearing polo shirts or button-ups.
Yeah, T-shirts, Jordans.
T-shirts sometimes. Yeah, unicorn laser cat eye tees, It's the really rich guy.
Yeah, it's the same joke in commercial real estate. The brokers show up in a BMW 7 Series or, high-end Tesla Plaid or whatever. And the rest of us show up in flip-flops and maybe a T-shirt that we wore to the gym a half an hour ago, but we're the ones who own the building.
Yeah.
I think the key is what you're comfortable with. Some people love dressing up nice, right?
I know.
That's what they feel good. Some people do that. Other people like to dress like scrubs. If you show up dirty and you smell, I don't care how rich you are, I'm kicking you out.
Totally. Yeah. It has to suit you. Or if you're just wearing something that's ill-fitting, then you're going to look dumb. Especially, I feel like the West Coast guys were a lot more comfortable in being less formal.
Yeah, that's very true. And most of the stuff we've done is on the West Coast too. I bet if we went to the East Coast private lending conferences, there'd be a lot more buttoned up people.
Oh, totally.
Well, and you hate for it to be this way because I'm super laid back. I'd be in shorts and T-shirts every day, but you have to know your audience too, right? We're buying a lot of commercial stuff and it's old guys, right? So if I show up in flops and shorts, they're throwing me out the door before they ever let me in.
Yeah, I imagine you're doing this at like at a McDonald's breakfast signing contracts. That's what I think of, like Midwest commercial real estate.
Or he's at a Denny's.
Except for the guy that's selling owns 12 of those McDonald's.
Right. That's what I'm picturing.
No, we go classier to Bob Evans or something like that.
Big time.
Yeah.
You're meeting Mr. Bob Evans himself. He eats at his own restaurant every single day.
Right. Yeah.
Cracker Barrel. That's what I was thinking of. Yeah.
So
Cracker Barrel. Yeah.
It's different. I would say like the finance space though it's very different from real estate because like there is a lot of like banker types, and also the level that people are at in the finance space is so different. Like honestly, Dan and I probably should dress up a little bit more because we're by far the scrubs compared to a lot of these dudes.
We look good though. We come in, we counterbalance it with having actual muscle on our frame. That's true a lot. That's true. It goes for a lot with a lot of these people.
Hey man, I feel like the last two conferences especially, we've been the only two people at the conference that hit the gym every morning.
For sure.
There's been nobody else in there.
Most people are too hungover.
Yeah.
Yeah, there's a lot more drinking going on at lending conferencies.
But we're also the only ones gambling. That's what I don't get.
That's true. Yeah.
So what are
we degenerates?
You have to pick your bad decisions. You can't do both.
Yeah, right.
Yeah, for sure.
Want to make a bet?
but like the amount of money that's there is very, very different.
Yeah. It's different money. Let's put it that way.
It's different
money. Because I feel like real estate money is always like, I have money, but it's equity. Where in the lending space, just by nature of it, there's just more money that's liquid, more cash. There's more available money flowing.
Like I've been to big real estate events, right? And they're like, oh yeah, we're having like a little meetup. You can get like a beer or something if you go to like the back room over there. Whereas like this, they're like, hey, we booked out this entire bar and it's open bar. Get whatever you want. They're like, you want top shelf tequila? Doesn't matter. Get it. Like you can just do everything. They probably rang up a $60,000 bar tab at the end of that night.
Oh, for sure. For their one little event. Yeah.
Easily, dude. Yeah. So it's just a different vibe. And so as a result, I think there's a little bit more professionalism because they're spending real money and they have real money.
Yeah.
It's fun.
I was along this same subject. I was talking to a fundraiser the other day, and he is like more in the multifamily space, like big 300 plus unit, like institutional, like multifamily space. But they've been, a lot of them, not just him specifically, but have gotten not great the past couple of years. They bought too high, cap rates went up, whatever. And having, this kind of fund structure is probably the most appealing to LPs that it ever has been, I would say.
Like debt fund structure, or what do you mean?
Anything that has offers a good LP return that's not multifamily is kind of my pitch there.
You think that's the criteria if it's not multifamily? What if I'm buying a zoo? Is that cool?
No, zoos are great this time of year, I've heard.
No, more in the real estate niche. So like what Drew's doing with commercial lending.
Right.
Zoos aren't real estate. There's a lot of land at a zoo. That's all I'm saying.
There is a lot to that, Dylan. But I was doing like a bulls versus bear argument on like funds and stuff like that. And it was with you guys all know Mike Orndorfer, smart guy. I trust him a lot with everything he does. And he made an interesting comment about they're going into multifamily right now. He's actually doing a deal up in like the Seattle area, I think, that he's raising for. And he thinks that single family actually has more room to go down. And where multifamily, he thinks it's kind of towards the bottom now. And so he's getting into it. And I reinforced that comment from him because we're at this most recent lending conference, not to keep beating a dead horse here. We talked to probably 2 or 3 different like president, CEO types of their respective fund or bank. And they were talking about wanting to get into the large multifamily game and large multifamily debt. And they're talking about how do we structure that debt to be better than what they used to have, because they know agency debt's impossible to get and it kind of sucks. It's not that great. So like they understand the issues with debt because you've got basically local banks, you got the agency debt. There's just the bridge debt that they're getting into to get these things locked up. So they understand all the bad parts of that debt. And so they want to come in with a superior product from the private lending space, but have 30-year fixed debt on large multifamily. And my guess is the only reason they'd want to be doing that is because they do think that in the next 12 to 24 months, maybe they are going to start seeing a slight increase on that. But you're 100% right, Dylan. Up until at least this point, everybody's like, I want anything but that.
I want to clarify. What you're referring to is GPs, people buying it now for returns later. My vantage point was if you're raising money from LPs or accredited investors, a lot of them just got wiped out. So like, I'm not doing that shit again.
Yeah, they don't care. They don't want it. You're absolutely right. They're moving away, which is funny because I do think it's like there's this crossover point that's probably coming. I'm speculating anyways.
Yeah. I think from the big money perspective I'm talking about, Dan, is you have these people that are desperately trying to outlay more capital.
Yeah.
And they're realizing very quickly that doing that with single family residential real estate is a lot.
It's a rat race.
Right? It's such a, there's a lot more assets, a lot more underwriting, a lot more, different analysis they have to do on things.
Less sophisticated borrowers.
Less sophisticated borrowers versus if they can get a low LTV on like a larger asset, they're going to be able to deploy more capital at, probably competitive or similar rates on stuff that they, see as like an uncaptured marketplace right now. And so, what that'll actually look like, who knows? Because what'll be really interesting will be to see if they start to change how they analyze those properties too. Because like fundamentally here you're talking about is it's not agency debt like talking about or like Fannie Freddie debt. It's true private money. And so like at the end of it, like even like the BlackRocks and these kind of things, like it's their own balance sheet that they're doing to carry this long-term debt. So they don't have to follow like cap rate rules or anything else to determine value. If they wanted to, they could just be like, yeah, we like this area. We'll give you a loan at 60% on this thing at that price because it makes sense because XYZ property down the street sold for that. They can completely abandon the traditional analysis.
And they're coming up with their own appraisal standards because we're seeing it. They're just like, cool appraisal. We don't care.
Literally.
We don't agree. We've had appraisals get like, we don't agree with the value. And you're like, but that's an appraiser. And they're like, we don't care. We don't agree with it. Mm-hmm. And they have their own inside due diligence.
That ever been provided to be good for you? Like, hey, the appraisal came back low, but we don't care? Or has it always been the appraisal came back high and we want a lower number?
It's always it came back high and they disagree with it.
Yeah.
Because they're going from a defensive position. But that's something that's really changing with the industry on the private side with like all of real estate is the people that are providing the funds are abandoning the opinions of the quote unquote experts that have always been the gold standard. And they are now developing their own standards to provide debt and to underwrite all these things.
They're just really looking at fraud is what they're looking at. And they're considering a lot of this stuff fraud. Like when you go and talk to your appraiser and you're like, I think these are my comps, that's fraud.
Yeah.
You're not supposed to do that.
Isn't there a gray area between like, you can provide them, but you're like, I expect this value.
Yeah, totally. And you're not going to be, when I say it's that appraiser who has a certification. And so if appraisers start doing that on a mass scale, like which they do in some of these markets, or they actually team together and say, hey, if you throw me another $100 on this $800 appraisal, that's a fraud issue.
Yeah. And so they're trying to get rid of that gray area completely. And their idea is instead of having like a black and white, they're going to have their own color. It's going to be red.
Yeah, exactly.
Right? It's got to be their way.
Ink.
How frequently does that actually happen? Like, I'm not saying it doesn't happen where someone tries to bribe an appraiser or something, but that's like this hypothetical example that goes out there. And I mean, of course, I try to do things by the book as best as I can, but like it wouldn't even enter my mind to try to bribe the appraiser just because, I mean, it's just common sense. You just don't do it. Does it actually happen?
Some level of fraud. Yeah, I mean, the appraiser stuff, it happens. Dylan's points, a lot of the gray area. So we'll get a lot of borrowers that are like, hey, we want to use our appraiser for XYZ reason. And it ends up getting rejected. But like in terms of fraud, so much more frequently than you would think, dude. Like we've had people submit doctored bank statements. We've had people like obviously changing things on like leases and like different stuff.
Yeah.
And to be fair, a lot of it, honestly, it's someone that is just sick of the bureaucracy that is trying to get their loan done so they can move on with their life. The problem is mixed in are these people and these enterprises that are doing this on like a mass scale, and they are embezzling a lot of money.
Yeah.
And so like last summer, there was this massive, it was several $100 million DSCR fraud that happened in the Northeast in Baltimore. In on this deal was these investors that were from overseas, right? And they had their appraisers involved in it. They had the title companies involved in it, right? They had everyone that could possibly manipulate the deal involved in this. And what they were doing is they were buying these properties for dirt cheap, and then they were overinflating the values, and they were refinancing out these huge sums of money on things that were not worth that. And then they just took all the money and jumped ship.
Yeah.
And, they stole like hundreds of millions of dollars.
So a big thing that people will do too is they'll be like, oh, I bought this apartment building for $1 million and I put $2 million into it. So now, and it's now worth $4 million, right? Well, then they didn't actually put the $2 million into it. But then a lot of times at the time, especially lenders were saying, okay, that's your new loan to cost. So they're not doing like a cash out refinance. They have a new loan to cost. So then it's basically a rate and term. So that's pretty fraudulent. But you can see that on a scale where we were talking to the president of one of the banks, one of the originators we work with. And he was like, our sister company basically happened to do the bridge loan. And we were doing the DSCR refi. And on the DSCR refi, the guy said he put $200,000 into this. Well, they have documents of the statement of work and the work that he showed doing all the draws, and it was like less than 100 grand. The whole story is the guy wasn't trying to be like a complete fraudster, but the way it worked out, they just happened to talk to them and they're like, oh yeah, we have that loan over here. And the actual work was like under 100 grand, but because the loan to cost statement was trying to be 200K, which they were going to do the loan with that at that loan to cost too, had they seen that. Right. And so like little things like that over hundreds of millions of dollars too, which is getting deployed.
If you catch someone in a blatant lie like this, instead of like the fix being, hey, let's make it harder for everybody, I just feel like take that person and put them in jail for 20 years. Right. And then like,
yeah. It's like, do you want to hear my theory on child molesters here? So it seems like a perfect time to bring this up. But you're right, Dylan. The challenge here is as a lender, like Mike and I, you hire employees and you don't see it. So like employees just click away, dude. They're just like, cool. Yeah. Even your best employee on this stuff, because you have people all the way from collecting documents to reviewing them, to underwriting them, to completing due diligence on them, to doing QC on them. So those are all different departments and different people. And they're just clicking buttons, dude. And so now you've originated, some of these places are originating $100 million a month easy. Like that's not crazy. That much money.
That is a lot of money.
Doing?
Kiabi's doing 500 to 600 a month, dude.
Yeah. So like, think about that.
Yeah, but they're the biggest player, right? Or one of the biggest players.
They are. Yeah, one of their biggest. Yeah. But there's a lot of guys underneath them that are doing 100 million a month, 50 million a month. That's a lot of loans to have, $60,000 employees being able to do these correctly and catch fraud. And so then they have to create all these rules because you've got the entire industry of $60,000 employees who are just clicking buttons and trying to get to their lunch break so they can do something else, and they just upload a file and don't check it. And it happens so often, then it just creates havoc. And so they have to create all these rules because
you're going to start seeing private investigator fee, $1,000. They're just going to do that on every loan.
Seriously, dude. I'm going to add that fee. That's a good idea.
There you go. You're welcome.
That's a great idea.
Drew, I guess with you just started your fund, which is cool.
Yeah.
So I guess how are you looking at like the wider sort of real estate space? And I guess like how are you standing out when you're thinking about your investors? And, there's this fraud, there's all the multifamily that's gone sideways. What have you found is effective to like make your offer appealing, while also not giving away the farm to all of your LPs? Because otherwise I kind of just missed the whole point of like doing anything if you're not making any money yourself.
Yeah, sure. I mean, we could take that discussion a million different directions, but I think you have to kind of start out knowing and understanding who the avatar of your potential investor or your desired LP investor is.
Yeah. And really quick, so what's your fund for? Just to give people a framework.
Yeah, sure. So my partner and I combined, we have about 14 years worth of industrial, commercial real estate acquisitions, full cycles, things like that. And we've not done a good job of letting people know how much of that we've done. A lot of feedback we get is, well, what's your track record? I haven't seen a lot of, I don't know, maybe it's our Midwest sensibilities. We just don't boast about it a whole lot. So you're seeing more of that.
You should write a book. Yeah. You should write a book that says, it's called like self-storage and shit. Just put a big expletive on there. People like that. Yeah.
If I write the book, then that'll be more ammunition for Mike to beat me up with later.
Yeah, exactly. Oh, he'll come out too. I see. Nobody's immune.
So we've done a lot of industrial. The last several years, we've acquired, it's just the snowball's rolling downhill, getting bigger and bigger. And we've really built this machine to source industrial properties. And so we've bought a bunch. When we've outgrown our own capital, then we started bringing JV partners in. And that's been a really, really good fit. We've been doing that for a while now. But those JV partners, when they jump in with us, they'll send us $400,000. Then we bring the debt. We go buy this thing, right? Well, their argument is, we love what you do. We're going to keep sending you money. But would there be a way, like when I invest with you now, that $400,000 goes to that one property. And if tenant goes dark or you have an issue there, all the risk is concentrated in that one property. So could we create a fund where we move those properties in, you guys acquire more and more and more. And this first fund that we're doing is built so that it'll hold 25 million in assets. And it spreads their risk out across multiple cities, multiple markets, multiple tenants, multiple verticals like oil and gas, manufacturing, warehousing, all of that. So it's kind of a windy answer, but that's the niche that we're really doubling down on and getting laser focused on.
Yep. Yeah. And you just buy good assets. This isn't a fix and inflate and all that sort of. You're buying good assets at a good price is kind of my understanding, right?
Already performing.
Yeah, most of them are stabilized, right? So in the commercial world, you're either going to buy something that's stabilized, meaning you have tenants in place and it's cash flowing day one, or it's a heavy lift where needs a new roof, or it's vacant, or there are environmental issues, or there's some sort of heavy lift. So the fund is geared towards stabilized properties, but we do occasionally take one value add because, for example, real close to where Dylan's at in Cincinnati, we just got a new one under contract. In the next 45 days, we'll need to close. And it's about a 7.2 cap from day one. And we can talk more about that if you want. But that's on the lower end of what we would put into the fund because it doesn't cash flow that well. But we think with some lease changes and things in the next 18 to 24 months, that'll be pushing an 11.5, 12 cap.
Oh, wow.
So we buy 2, 3, 4 stabilized ones for immediate cash flow, and the monthly distributions for our LP investors will then sprinkle in an occasional value add where we can really ramp up the value. But the focus is stabilized.
Are you getting like bank debt on these as well? Or are you buying them cash?
No, there's absolutely bank debt. And so that's one of several points that I could probably dig into to talk about how we align with our LPs, because every syndicator, every fund manager is going to come to you and say, oh, we're perfectly aligned with our LP investors, right? But here in a minute, maybe we can come back to it. But there's fees to talk about. There's all these different things. But one of the key things that we do that's atypical is, say you're going to go buy a $25 million apartment complex. Well, your sponsor or your operator is probably going to go get non-recourse debt, which isn't evil, but it means that if they lose that, they're not putting their house on the line. They're not putting all these other things. Now, there may be bad boy clauses in there, and if they really get nefarious and stupid, yes, the bank could come after them, and there is some risk there. But with us, our deals average like $1 to $3 million in acquisition price, and in this $25 million fund, we'll stack up probably 12 to 20 of those. But they're small enough that most of those loans will be full recourse loans. So the LP provides the down payment. Tyler, my partner, and I bring the debt, but we personally guarantee all of those loans. So I can't afford to buy a stupid deal that's going to go sideways and be risky with your money, because they are going to come after my house and my livelihood and all of that.
It will wipe you out.
Yeah.
That's so fascinating because that is so rare. That is honestly just such a rare structure.
It's really atypical.
And you also, just because I know your pitch is like, you're not incentivized by acquisition because you're not getting fees and stacking stuff on their management fees. You're really incentivized by getting high quality cash flow and assets so you don't lose your ass personally.
Yeah, I mean, that's kind of the other bit of alignment that I think we're really leaning heavily on. Now, I'll start by saying there are a lot of good operators out there. They charge fees. I don't know that fees are necessarily a bad thing. And the day might come where we go to Fund 2, Fund 3, where scale costs something, and there may be fees eventually.
Yeah, totally.
But here on the front end, like one of the biggest problems with syndications and funds, not problems, but at least misalignment in my mind, is if you go buy that big apartment complex or that commercial building, the sponsor gets paid 6 figures, $100,000, $250 day one to acquire it. And then they offer you a pref, which means it's kind of an IOU. It's not real money until you start paying it, but it's 8% this year, and then it's 16 the next year if they haven't paid any. And that pref can start to get so big and overwhelming that operator starts to get behind. And if they can't get it caught up, their incentive is not to get the asset to perform, but to go transact another one to get another fee to pay their own bills, right? So with us, there are literally 0 fees, because I don't think you should have to pay an operator to transact. Doesn't mean it's evil for the guys that are doing it. There are reasons that they justify doing that, and maybe we'll come back to that someday. But for us and our fund, I literally get paid nothing until you're getting paid with monthly distributions, and we get paid side by side.
Drew, are you doing 506C or 506B?
506C. That's how I can stand here and openly solicit and shout it from the rooftops. If not, I'd be gearing up for SEC jail.
Yeah, no, and to the difference.
Mike would report you.
For the audience is basically C, you can advertise to accredited investors. B is kind of like your inner circle, but not accredited investors. Are these LPs people you've known over the years from your medicine days, or are you talking to new people? And I guess like, what is the demographic? Are they older? Are they retirement age? Do they want the depreciation that comes with buying real property? Or is it more the income side of things?
Yeah. So it's funny because it's a little bit of everything. I have a meeting here at 5 today with physicians from my previous life. And so we'll see if that bears fruit. Our first tier of people that we've gone to are all of our private money lenders that we've used to flip houses and all that sort of stuff. I mean, they get the first seat at the table, and we've got a couple of those that are jumping in, the ones who are accredited investors or will qualify for that. Beyond that, then, like even our lawyers that I've been working with the last couple of years, we've got a couple of them in their office who've been watching us forever, who said, look, we're going to have another team represent you. So there's no conflict of interest because we're ready to put money in.
Oh, that's really good. Yep.
Yeah. I mean, it shows the value of like, just be steady, be consistent, do the things you say you're going to do on all the little things. Because if you can be trusted with little, you can be trusted with much down the road.
Tell me about because you don't hear much about industrial. I mean, you kind of do. And I know talking to you, we do, but we were talking about, apartments was a big one that everybody was talking about for years. And then, you've got everybody on the other end of things too. But what does that market look like? How are you guys doing this? Because it's cool. I can't imagine Mike and I could do it in Spokane, but the Midwest is a completely different market with your guys' industrial base and everything. So I'm just curious to...
Well, Andrew does travel a little bit. If you could touch on that too. I know he does.
We do. Yeah. Our target market is, 3 or 4 hours of where I'm at in Fort Wayne, but that gives us Detroit, Chicago, Indianapolis, Louisville, Cincinnati, Columbus, Canton, Dayton. Like it's actually a pretty meaningful series of MSAs. But Dan, to your question, I think you don't hear a lot about it because one, it's not sexy. Like I can put it on social media. It's a big metal box and it's sometimes it's clean, but sometimes it's a workshop. There's tools all over and little oil stains here and there. And it doesn't show as sexy as the granite counters, or if you do a big retail something and you make this beautiful, storefront or something.
That's why you got to go out there and just like chastise someone that's at the site, like really aggressive, and then just like show them this is like what passion in business looks like.
Just bring Investor Girl Brit with you.
That works too.
Right. We just need to find one of those. I keep hitting my wife up for that, but she's not.
Yeah, she's not showing up. So she's like, nah.
Add that to the list of things that says no.
Yeah.
Cross it off. So I think another part of it is it's not very relatable to people. Everyone has lived in an apartment or everyone has lived in a house. Like they know what that should look, feel, and be like, at least a little bit. So maybe it's a little less accessible because people don't understand like who rents these buildings, right? Well, it's not a family, right? I mean, these are businesses, whether they're big or small or corporate or global or whatever. And so I think that's kind of part of it as well. But the magic of it is it's in the numbers and the analysis, and we've kind of created a niche within it. And so I think so many people have flocked to real estate and investing because of Instagram and social media, because it pops up and it looks good and you see it and you see it and you see it. With industrial, no one's just going to throw up a spreadsheet and be like, hey, this makes way more money and the risk is a lot different. And here's some magic.
Yeah. What's interesting to me that I want to hear about, because you're talking about the numbers. So, Mike and I were with Matt Atchison, I can't say his name, Atchison's, whatever. His commercial.
Matty A.
Thank you. I'm hooked on phonics.
It didn't work.
Anyways, I don't know if he still runs it, but he has a mastermind. Mike and I were in the first year that he did his mastermind talking about commercial real estate. He was more focused on like the retail side. That was his specialty. But there's guys in that group doing industrial, everything, right?
Yeah.
He talked a ton about lease structure and how there's a lot of value add in lease structure alone. Do you guys look at lease structure from value add? I mean, like, how does that come into play with you guys?
It's everything. And I didn't understand it when I was coming to it. Like my partner had been in it for 9 years and I've been in it 4 or 5 now. And my biggest roadblock was understanding, like before when I was doing residential, you're buying the building, you're buying the property. It needs to look good. It needs to be appealing. People need to desire it. Some of that is true on the commercial side. But what you're really buying is the lease. You're buying an income stream, and the income stream is created by the lease. And these leases are generally not 1-year leases. These are 5, 7, 10-year leases. And so you've got to get them right. But they can take we're buying one, sellers are signing today, I sign tomorrow, where it's $650 is the purchase price. And we're signing a new lease hopefully Tuesday when I go up to visit with the tenant. That'll change it to a $1.1 million building.
Wow.
Just overnight because of the lease.
Yeah.
So yes, that's the value add you want.
So it's funny that you use that example because I was just about to say there's a commercial guy here in town that he says, what I like about commercial versus multifamily is I can double the value of my building with the stroke of a pen. You can't do that in multifamily.
No.
Yeah.
No.
Right?
Yeah.
I mean, there's some things in multifamily because it's technically commercial, right? So you put all new granite, you add washers and dryers and all there's things you can do. But if you're buying a $300,000 house on a road of $300,000 houses, you can do it to the nines. And maybe it's worth 320, 325.
Right.
But you're never going to double the value of that house unless all the other houses start to double.
Right.
That's the difference.
And it seems less common when you're the owner of this like industrial property and stuff like that you need to put the actual CapEx into it. A lot of times the tenant is improving it to fit their needs. So a lot of value has to be on the lease. I'm guessing there are opportunities if you do pick up a vacant building where you're like, hey, we need if we upgrade the electrical, it'll open up to this type of person. Or if it's got a leaky roof, are there things that you guys do to modify these buildings at all to like add value, or is it purely lease?
To piggyback off that, to answer the same question, are most of your leases now, do you try to do them as triple net or no?
That's a key strategic piece is moving to triple net for sure. And so Dylan, maybe we come back to that. We can dig into that a little bit more, what it means and how to do it. To Dan's point, I think we chose industrial because of all of the renovations or what we would call tenant improvements or TI. Mm-hmm. It's the least of all of them. So if you think about like a retail place, retail might come in and that business wants you to paint it a certain color. They need these countertops to match their franchise. Like you know, for a normal retail space, you might drop $100,000, $150,000 in TIs that are very expensive when you have that tenant turnover.
You know, they call it tenant improvements, but it really should be called owner improvements. It always confused me.
Yeah. Yeah. You know? Because it's all negotiable. Like maybe they bring 50 and I pay 100, but like there's going to be something that I'm going to have to plan to change. Yeah. And kind of similar with office as well. It's not as bad with office because office isn't hard to white box it and clean it up.
Sure.
But with industrial, I mean, you've got, for the most part, it's a giant big metal box. It needs to be clean, needs to be safe. And you might have an office. We've done a couple little office spaces, but I mean, you're talking about clean white paint and some, industrial strength carpet and that's about it. So it's atypical that we have a very expensive turnover. Plus industrial tenants come into it knowing like, hey, we're going to make this space ours. Like we're bringing in huge machines. We're going to buy equipment. Like their demands are very, very low by comparison.
Interesting. That's really cool. I like it.
This has been great because I've learned that I'm definitely in the position of my life where I'm an LP because this is boring. like just like the real estate numbers. I'm like, I don't give a shit, man. Like, that's great. I trust people like Drew to be good at these things. And because I know Drew very well, but I've now learned that I want to just pay people to be good at these for me. And I'm more than happy to give you my money.
Yeah, right.
Maybe that should be my goal, right? It's just bore people to death and just be like, hey, don't worry about it. I'll take care of it.
Yeah.
Let's go.
I'm glad it gets you excited, though. And to Mike's point, I'm glad it does because that's the one thing I wanted to ask you about in relation to your fund, too. So Mike and I so I'm not going to say it's a goal, but it's something we're focusing on a little bit as a side project is depreciation because we are kicking off a lot more cash flow than we have in the past from our active income. And so now we're like, okay, that sucked writing that much money into a check. Is there a strategic way where we're not taking away from our main business for us to get some tax benefit? Do you guys offer that with your fund?
We absolutely do. Before I answer my version of it with our fund, maybe let's just talk about that, right?
Yeah.
I think there's a lot of value in finding tax incentive and depreciation, but for a lot of people, like the tail wags the dog. And we need to understand that tax benefit is the icing on the cake.
Right.
And so in the last couple of years, we've seen a lot of people go hard after syndications or big funds, like the ATM stuff. You guys have you seen the ATM? Okay. So you put $100,000 in and you get 100% or more loss in the first year to offset your income.
Well, that was a scam too, right?
Well, everybody knows now because they lost everything, right? And
they lost everything. Yeah.
I never understood this. Were they actually investing in ATMs?
No, dude, it was a Ponzi scheme. So they were like literally just taking.
Well, why do they call it ATM? Because that means something else to me.
Because that's what their pitch was. They're investing in ATM because you can depreciate these things at such a massive rate. But anyways,
okay.
Well, and to your point, I mean, I think it started out with good intentions, but they bought these and they didn't work and they needed more money to spool it up, and it evolves into a Ponzi scheme. But Dan, to your point,
then it's a really good tax incentive because you lose all your money.
That's right. You have so many losses to offset for the next couple of years. It's brilliant. Yeah. So if taxes are a driver for you, that's one way to do it. And so I guess what I would say is there's a lot of groups out there who will give you huge amounts of depreciation, which is amazing. But I don't know, there's a risk reward that really needs to be calculated. And if it sounds too good to be true, it might be.
You need some capital preservation, right? So if I give you $100,000 and I get a tax benefit, I don't want my $100,000 to disappear. Like we're talking about this ATM fund and all that sort of stuff. And the one thing that like Mike and I are looking at is like, we have to have an office for our business. So do we go buy a space, not an office building, but a space that could be an office that we could depreciate? We've talked about potentially buying like an Airbnb, and does that really actually make sense? And the hiccup on the Airbnb thing for me is like, okay, say you go invest a few $100,000 in Airbnb, we can do accelerated depreciation on it. So we're gonna get some massive tax benefits. But what if you like lose money every year on the Airbnb too? And so then it's like, now you're getting more losses, but it's like, do I really want to lose? Because you're still losing the money. Who cares if you're fucking not paying taxes on? You're still losing the money. It's gone.
Well, and like we've ranted on this show, like, I mean, that's a job. That's a heavy job. And maybe you hire it out. Okay. But now you have an employee and you're also signing on for more debt. Do you really want to sign on for more debt?
Right.
Isn't the LP depreciation still rather minimal unless the LP is also a real estate professional?
So to answer Dan's previous question, the depreciation you get with us is you should expect 20 to 30% of whatever you invest in year one, because we take bonus depreciation. So $100,000 in, you should expect 20 to 30 back. Now, what you get to do with that 20 to 30 depends on your situation.
Yep.
So if you're a high W-2 income earner, but you have no passive income to offset a passive loss with, you probably can't make...
You can't use the same benefit.
Exactly. Yeah, that's kind of my point. Yeah, right.
And so I have a guy just like that, works at the hospital. This will be his first passive income investment. So all of the income that he makes from us will be able to offset, but he probably won't be able to use all of that. And so I don't know how that carries forward. And that's a very individual type of thing. But Dylan, you're absolutely right. Just because someone says, hey, you're going to get a $50,000 loss, if you don't have 50, doesn't mean you're going to get it.
Doesn't mean that they can apply it to their situation, right?
Which is why a lot of the doctors and lawyers got into the short-term rental game is because there was that loophole, which it sounds cool. I've never really looked into it as deeply, because it's just, to your point, Drew, you said it's a job, it's a risk, it's more debt. There's a lot of stuff surrounding that. But the idea though is just that tax benefits would be super nice if you could get, if I gave you $100,000, you gave me $30,000 off my tax bill or off my taxable income, like that would be super cool.
Yes, but to your point though, assuming they don't lose the $100,000 in the next 3 years.
I hope Drew doesn't lose it.
Yeah, I mean that's the thing is if you're doing it yourself, like you have to set up your investment thesis, and that sounds complex. I don't have a big thesis like written down, but what I know is I'm building a work style business, and so triple net tenants where everything is on them. No one's flushing diapers at 3 a.m. I also don't want multifamily and storage and all these things where I've got 1,700 units. I have 17. That's a lot easier to manage. So like, I think there's a lot of reason behind why you design what you want to design, make sure the returns are what you want, and then decide if the tax incentives that come along with that make sense with it. I guess that's my pushback with the Airbnb. If Airbnb aligns with your investment thesis, then absolutely go get it, because the tax incentives, the icing on the cake is thick.
Yeah. Interesting.
Yeah, I don't know. It's
This is the episode where Mike has talked the least, by the way. Out of 480 episodes, this is the least dialogue Mike has had.
It's funny because he's
something that change it. Pace Norby. Elliot Arnie.
Yeah. Well, no, the thing that I always get stuck on personally is you're right. You talk about like your investment thesis. I hear this so much, and everyone's investment thesis is honestly the same of like, you want to make more money and you don't want to lose your money, right? And I feel like giving it a fancy name, it just makes people focus on the wrong stuff.
If that's your investment thesis, you're doing it wrong.
Yeah. To make more money and not lose money, what could it possibly be besides that?
Well, those could be guiding principles behind you're building.
But you got to have a plan.
Yeah, I mean, you need to think about what your risk profile is and like, where you're at in your phase of life, what you want to achieve.
What Drew's saying is he can't do this fund in Spokane, Washington. Like, I think that is part of his thesis is like it being in the Midwest.
For sure. Yeah.
Maybe.
My challenge is for people chase either the return or the tax or whatever. And they need to decide, what do you want your life to look like?
Yeah.
Right? Because I see a lot of operators building things that make their life miserable. And maybe they throw off huge amounts of money, or maybe they have all these huge tax benefits. And these people are effing miserable.
Yeah, totally.
And I have no interest in that. And so I guess that's kind of what I'm saying is make sure that the assets that you chase or the streams of income that you chase are in alignment with what you want to build. Maybe that's a better way to.
I hear what you're saying too. The way I interpreted you is like, there's a lot of ways to do what Mike said, make as much money as possible and pay as few taxes and don't lose your money, right? There's a lot of different ways to do that.
Lots of different ways. Yep.
How do you want to do, like, you got to have a plan of how you want to do that. I've realized over the last, 12 to 24 months, buying more single family homes in my local market is not how I want to do that. But 5 years ago, that was my thesis. Like I was like, I'm going to buy as many of these as I can. And it made sense at the time. It worked great for us. The market's different now. And that to me, when I wake up in the morning is the last thing I want to do. And so it's like, I've had to switch my investment thesis and really rethink that. And my investment thesis is the last 12 to 24 has been like, invest in myself as much as possible. And it works. Like I make way more money now.
Could you imagine doing the past 5 or 6 years? We've all done the wholesaling business at some point of doing that over the past 6 years, and you like broke even. Like you, that would suck a whole lot. Like,
yeah, we all benefited from it.
There's a lot of people like that. Totally.
And that's my point. Like, you don't hear about those things, but like they definitely happen.
Or they lost money. They broke even or lost money.
The only way that it did work for me is because I held as much as I could. Like for me, that machine was to stack rentals that all just appreciated like crazy. But there were probably a couple of years where I was losing 30 grand, 80 grand, something like that. But I was stacking net worth that was just silly and appreciating.
Getting multiples of that in paper money.
Yeah.
Yep.
And maybe this is just where my personal privilege is showing at this point, because there's also a lot of, I have surplus, right? My lifestyle is kind of what I want it to be. I make more money than I need, and I have a good runway, right, in terms of like equity and everything else. And so for me, my general philosophy is like, I'm not trying to be like, I want to be able to cook breakfast for my kids. That doesn't fill me up. Like I can already do that, like honestly, right? It doesn't matter.
But if you couldn't do any of that, you would be probably worried about it.
For sure. And it would have more of a thesis around it. I guess my general philosophy, what I like and what I think a lot of people actually want, but they don't fully realize it, is they want some sort of control over it. This is why we get like LPs that are even in our fund and like different stuff that we do, like people that invest with us, is like they are overbearing in the information that they want because they want control, but they don't necessarily have it. But they also don't want to do it themselves because, like you're talking about, they don't want to work. They want to like hang out. They want to do whatever. And you can't really like do both of those things, right? Like as you're an investor, you're giving up control because you are investing your money. If you are putting it into your own business, I guess it's still like a quote unquote investment, but that's much more active. And that will give you a much higher return, but that's where the control comes from. And that will give you higher multiples.
Yeah.
And I guess for me, like that's always been the trade-off, is like every dollar that I have in a investment is something that I lose control of, that I can't multiply in a much shorter period of time.
Well, and I think that's, I guess, maybe through, and I don't know your world perfectly, but from what I know of your life, I guess that would be my challenge, is now that you're kind of killing it, I guess we wouldn't call it W-2 side. I don't know what it would be, but your earned income side.
Full active,
right?
yeah.
Yeah. So now that your highest and best use of your time probably is your earned income channel of money, right? Mm-hmm. So if you're going to, I guess I would encourage you to do as much of that as you can, and then place capital strategically, like 15% in crypto and 15% in mobile home parks and 20% in industrial.
50% in Drew's fund.
I wasn't gonna say it. It goes without saying.
Yeah.
No, but then have, 30% of that pie or something be something that is strategically tax advantaged. You're going to get some of that from the whole pie, but if you need something to really go hard at it, do it that way. I have a couple of key investors who say, I need my portfolio to have 10% industrial, and I'm going to send you 200 grand every year to keep doing exactly that. The rest of my money's going somewhere else.
Interesting. How do people figure this out? So I want to know. I'm just like, I'll just hold on to it.
Well, and everyone's different too. You ask 100 people, you get 100 different answers.
Yeah.
Right. Well, I think maybe you're worried about giving up control, Mike.
Totally. I mean, because like that is when we've had control of our own money, Dan, and the 7 years now we've been in business, we've been able to do a lot with it. And pretty much every time we've been in like a bind, it's because we locked it up in something that we shouldn't have.
For sure. Yeah. I mean, that happens inevitably if you do all the things we've done. But yeah. No, you're right. I think there's a time, and I'm not quite there. I mean, maybe I am. I don't know. Where there are things in life that distract you in a good way that make you need to give up control and invest.
Yeah.
You know, so you say you get to a point, you get a couple little kids running around you and you're like, oh man, I got to go do this. I got to go do that. I can't work right now. What if my money was working for me?
What if I hired a new employee that I paid $55,000 a year that just did those things?
Totally. Absolutely. Yes. And I guess that's one way to look at it, right? Go pay $100,000 employee or some people bring in house staff to take care of their personal things. And maybe you pay them 60, 70 grand a year because it gives you more time to do stuff with your family.
Yeah, exactly.
Well, and the key thing, like with us, like most of us are killers of some nature, right? Or you go to GoBundance, they're all type A's, like meaning we all have a thing that if the highest ROI is the goal, you put it in your own thing. You control it, you drive it. You can make multiples for yourself that no one will ever create for you, right? But at some point, like for me, maybe it's because I'm ancient. Even Dan makes fun of me about being old, and he's like 18 months younger than I am. Right? But
the gap keeps getting shorter. I don't know.
Yeah. But like for me, eventually, I want multiple streams of passive income, right? And so that's what our fund does. Is it really appeals like to physicians or people in their 40s and 50s are starting that transition to, hey, like I don't want to do this forever.
Yeah.
And with us, you make the investment. In years 5, 6, 7, we start to refinance capital back out, but you retain your shares indefinitely and you own these assets with us in perpetuity.
That's the cool thing.
And that's not a good fit for everyone. It's not a good fit. If you're looking for the highest ROI, usually comes with higher risk. That's not what we do. Yeah. So that's why I say like people kind of need to know what they're pursuing. If they want to work for the next 10 years, making as much earned income as they can, they should focus on that and sprinkle their money other places. And some of those will give you big returns. Some of those can turn into passive things for the long run.
Yeah, 100%. And I know Michael will agree with this, despite the conversation going towards investing in yourself, is at some point in time, you'd have to take some chips off the table. And if you keep putting all your money back in your business, this is what go back to the wholesalers that broke even or lose. A lot of times it's because you kept reinvesting in your business and then all of a sudden it went away.
Yeah.
Sometimes having equity in your business is not necessarily the best thing, or like, hey, let's buy this new equipment, let's buy this new asset, let's reinvest in this new system. And not everything works out. In fact, like 8 out of 10 things I feel like don't work out that you spend in your business. It's the 1 or 2 things that work out that make all your money. But eventually the clock runs out. So if you invest too much singularly, you don't take enough chips off the table, i.e. paying yourself, the risk is really high.
Hormozy, I don't know when it was, is a really good podcast on that entire subject. And actually, after listening to it, I took like a 6 figures for myself. And I was like, just going to put this away.
Really?
Yeah.
Yeah. Just do it. Yeah. Take it off the table.
Well, you're really talking about concentration risk, right? Like all your eggs in one basket versus having them somewhere else. And again, I get it. We're creators. We want to create in our own world because that's where we get the most multiples. And it's not that I'm that much older than you guys, but I just had kids when I was like 12 years old. So like I've lived through a whole different phase.
That's the Midwest thing. 9.
Yeah, it kind of is. It kind of is. But my point with that is like, you guys will probably get to a point where you're like, okay, if something happened to me today and my wife stay at home, or maybe her income is something different. Like I like streams of passive income that my partner can help carry forward, that doesn't make my wife go back to work for the next 15 years until retirement. And, maybe you guys aren't tasting that yet because you're so busy with diapers and PTA meetings that you just don't know.
Yeah.
But I would encourage people to start thinking about like, okay, as I head into different phases of life, what do I need to set up that's going to carry me a little bit further? Stock market can be you need to figure out what that looks like.
I agree. I can already taste it. I've got an 8-year-old at home. And so it's like at some point in time, I know the clock will really start. I don't feel it now. I'm just so into it. But like the clock of like, oh, the days are running out because, I've got 10 more years with it, which feels like forever. And I know you've gone through this with your kids, Drew. It's like at some point in time, it's like, I don't give a shit what's happening right now. I'm going to go do this with my kid or go to this event or take them to this trip. Right. And so like that stuff, being able to like set my life up to be able to do that. And that doesn't necessarily mean passive income. It just means I have to set my business up to be able to do that. And which is not always easy, as Mike and I find out sometimes when I'm out for a day. Yeah, it's hard.
Cool. All right, guys, we got to wrap up here. Drew, thanks for coming on the show and being a father wisdom, as always.
Yes.
Yeah, father time. Yeah.
I really do. I'll just give you a shout out, Drew, because I really do. I think your pitch of your fund, not that that's what this show was meant for, but like it's a good pitch. If you guys want to hear more, like you should reach out to Drew because it's a unique setup. Like I have never seen somebody set up a fund as honest and Midwestern as Drew.
Yeah. And is it flying investor on OnlyFans? Is that what it is?
Yeah, on onlybuttfans.com.
Yeah, OnlyButtFans. I like that. God damn. You should get that website, actually.
You should get that domain.
I know.
Actually,
yeah, that'd be smart. Yeah, but then I got to do something with it, and I
you don't. Just
divorced. Who knows?
Yeah. But do you want to say actually where people can find you?
Yeah, sure. So my company is Clear Sky Commercial. You can find us clearskycommercial.com, or me personally, you can follow me on Instagram at The Flying Investor.
Hold on. Drew's phone number is... No, I'm just kidding.
Yeah, is 616-324. I don't know the rest. Sorry. But all right, everybody. Well, thanks for listening. And check out what Drew's doing. If you guys haven't followed him after so many times in the show, I don't tell you. It's a good follow. Smart guy, obviously. And he fits in with the rest of us, as you can tell. So thanks for listening. We'll talk to you guys next week. See ya.
See y'all.
This episode is sponsored by Sir Lancelot LLC, also known as SLA Capital, which, if you didn't know, is Dan and I's private lending company. So yes, we are sponsoring our own show, but what you going to do about it? It is our private lending company that offers hard money and DSCR loans to real estate investors of all types. So you can be a new investor, an experienced investor. You can be buying flips. You can be buying rentals, whatever. We can do everything. And not only that, but the rates that we offer are just as competitive, if not cheaper, than pretty much every other company out there. So whatever big company you've been working with, bring us their term sheets and I guarantee that we can probably beat it. We have the same connections they do. We just don't have all the overhead and middlemen. So if you want to come and check us out, go to slacapital.com/keys and I will know that you came from the show. And by seeing that you came from here, when you get to closing, you will save $500 on your first loan with us. So slacapital.com/keys, we would love to fund your next deal. Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorMan Dan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.